Welcome to our higher education webinar on Beyond the Outlooks, our second annual conversation with the rating agencies. I'm Jim Landman in Kaufman Hall's Thought Leadership Group, and I have just a few items to note before we begin the webinar. First, we encourage you to ask questions throughout the webinar using the Q&A function on the webinar platform. We will get to as many of your questions as time permits during the hour. Second, we are recording this webinar and will share a link with you in an email within the next day or so. Joining us today are Emily Rames, Associate Managing Director at Moody's Investor Service, Emily Wadhwani, Senior Director at Fitch Ratings, and Jess Wood, Senior Director at S&P Global Ratings. Today's webinar will be moderated by Jason Sussman, a Managing Director at Kaufman Hall and leader of our higher education practice. We thank our panelists for taking the time to share their insights with us today, and I'll now turn the webinar over to Jason.
Thank you, Jim, and good morning or afternoon, everyone, depending on where you are. Let me add my thanks to the two Emilys and Jess for taking the time to be with us and to accept our questions and give us answers to hopefully to all of our questions and all of your questions as they come in. If we can start with the fact that all of your agencies, all of your organizations issued outlooks mostly in December, and for 2024 for the higher ed sector. And so I thought we would spend a couple of minutes with each of you describing your outlooks, any issues that you've identified, unique aspects and so forth. And that'll start off the conversation. And we'll do it alphabetically. So we'll start with Fitch, with Emily Wadhwani.
Thank you, Jason. I know I was trying to figure out like first name, last name. This could be tricky. So in a bit of a backdrop, we're now in our third consecutive year of what we call a deteriorating, a negative outlook for the sector. It really is a sector outlook and not a rating outlook, just to be clear. And we did a mid-year revision back in 2021, and this is where we've been since. And it in our view sort of reflects a lot of the core kind of credit factors that are still present. They've been easing in recent months, and we do think some of these pressures will ease as we continue to head into 2024, including macroeconomic conditions, challenges around labor and wages. Those things have begun to ease already, and we do expect them to continue easing as we head into the rest of the year. Elevated operating costs, generally soft enrollment, albeit we had some bright spots in fall of 23, and still relatively elevated interest rates impacting things like effective spending power and cost of capital for many schools. And so all of those things we still think are generally present a generally negative operating environment for the sector in our view. And while some of those conditions are going to diminish rather than accelerate during the year, we do think that's going to be borne out in sort of rating actions and particularly as you start to sort of look at the lower end of the rating scale. And we did see some of that in fiscal 2023, although we did see relatively balanced rating actions. What we started to see was a shift in rating outlooks in the latter half of the year. At a range of sort of 2 to 1, we saw an unfavorable shift in outlooks in our portfolio as we headed into the latter half of calendar 23, and those conditions were a large driving factor in those outlook revisions. And so we do expect to see relative rating stability. As you know, we rate the three of us tend to rate the higher end, the most creditworthy of the sector. Broadly, we do expect to see some pressures continue as we head into this year. And that's reflected in our negative outlook.
Okay, thank you. Emily Rames.
Yeah, thank you so much for having me. You can call us like Emily 1 and Emily 2 or something, Emily or Emily R. It's going to get confusing if you call on Emily's, but thanks so much for having me. Yeah, our outlook is like Fitch's. It is also an outlook that is looking at kind of the business conditions rather than ratings and rating movement. So it's not an expectation of where we think ratings are going to go. It's rather the business conditions. So a lot of the points I would make, Emily's already made, Emily 1 has already made, of what we're seeing. But the difference is that we moved our outlook from negative to stable. So a little bit of a different view, I guess. We seeing similar things. Our sort of view and expectation is that while we're still seeing pressure on revenues, pressure on expenses, expenses still high, still higher than revenues, we're seeing that narrowing, that sort of gap and deficit narrowing. And so we feel like we've kind of hit the trough, and are starting to see stabilization. So I think that we see in terms of ratings, Emily mentioned that they saw more negative outlook changes and things in the second half of the year. We saw well more downgrades and negative outlooks in 23 than we did in the prior 2 years. So we're definitely seeing pressure on ratings, and we see that condition kind of still exists, but we do think that there's been we've kind of hit the bottom, hit the trough, and the schools are adjusting to the federal aid going away, and starting to see some sort of stabilization in expense costs, be able to kind of bring that gap down a little bit. So yes, we are at a stable outlook, even though we are seeing many more kind of negative outlooks on ratings or negative rating changes in 23.
Thank you. Jess?
Hi, everyone. Thanks for having me. So I think a couple differences, that I would point out for S&P. So our sector view, while we do take into consideration industry trends and what's going on in the sector at large, it is also a reflection of our rated universe and what we're seeing and what our expectations are for rating actions throughout the year. So I wanted to define that. Our outlook for 2024 is bifurcated. It's sort of a weird word. When you look it up in Webster, that sort of speaks to a divergence, a path diverging. And I think when we look at higher education over the past 2 years, where we've been bifurcated, we are really seeing that credit divide. And I think we're lucky at S&P that we have the latitude to utilize that sector view, because I think in our view, it really sort of captures what's going on. I just want to repeat many of the things that have been talked about in terms of some of the operating pressures impacting higher ed, we think in 2024 very much continue. And when you look at sort of the revenue side of things, enrollments have stabilized a little bit, but like Emily and Emily both said, it's just not equal across the sector. And so you have some higher rated, very selective institutions, enrollments look great. And you go down, you kind of go down the tiers a little bit. And when you get to schools that are less selective and very regionally focused, with not as much draw, sort of outside of maybe their immediate areas or outside of their state, we're still seeing enrollment pressures. So we expect that to continue. On the expense side of things, we saw that during the pandemic, many schools sort of made a lot of expense cuts. So I kind of use this term, but I think a lot of the low-hanging fruit from an expense reduction standpoint has been done. Schools have been looking for several years at programs and where they can make adjustments. So I think our view for 2024 is that there's not going to be a lot of revenue recovery, and expenses are going to continue to be high. I think on the balance sheet side of thing, there's a little bit of a silver lining in that when we look at cash and investments for the sector and for our rated universe over time, cash and investments to operating expenses and cash and expenses to debt still remain stronger than pre-pandemic levels. So if we look back at those ratios in 2018, the average numbers today are better. So while there's market volatility, while there's economic uncertainty, the schools, as we look at our rated universe and just generally looking at market returns over the past couple of years, we know that schools sort of enter this year with some continued balance sheet strength. Trying to think what else. I think when you asked about rating actions, when we look back over the past few years, obviously in 2020, we saw quite a few downgrades. In 2021, upgrades, downgrades were about even across our rated universe. And in 2022, we had 15 upgrades, 21 downgrades. Last year, we had 12 upgrades and 23 downgrades, so more downgrades. But when we look closely at those downgrades and our bifurcated or mixed outlook of those 23 downgrades, the vast majority, over 90%, were BBB and below. In our rated universe, while all of our rated entities are very self-selective and tend to be the stronger schools, perhaps compared to the market at large, our rated universe, about a third of our rated universe is BBB rated and below. So we do see quite a bit of variety across that. I'll stop there.
Jess, I just would jump in. I think you said you had 12 upgrades and 23 downgrades in 2023. We had 12 upgrades and 28 downgrades. So very similar, right? That's kind of interesting to me. And I think when I heard that you guys had a bifurcated outlook, my reaction was, wait, can we do that? I mean, I think, and the answer was no, but I think we're in real agreement that there's, in terms of credit, there really is some bifurcation. I mean, the fact that we had 12 upgrades, I think, is interesting, right? I feel like as we look at the sector, where a big portion of the sector, even while we are all rating the most highly rated and the best, we're still seeing real struggles with enrollment and sort of a little bit of a push down of the sector. The ones where we're not seeing that tend to, we tend to think about that as positive pressure, because wow, if you are having any enrollment growth, if you are having any real revenue growth, you're looking really good compared to the sector.
Bucking the trend. Yeah,
right. You're bucking the trend. So it's kind of like you're either down or up, so the bifurcation definitely sort of rings true for sure.
So Emily ranks. I'll do it that way as opposed to 1 and 2. Don't want to get into that. Just to dig into your outlook a little bit, your stable outlook. Is that a question of being a glass half full perspective? Is it a timing perspective that you're seeing the recovery happening more quickly than the other two organizations? How did you get to that stable versus the other deteriorating?
No, great question. I don't think as analysts that we're ever glass half full. I think we're sort of
just wanted to put that on the table.
half empty types of people. I think that it's probably the very slight kind of differences in what we're viewing the outlook as. And I don't know exactly, but we endeavor to, I think that what we found over the years as being kind of glass half empty people is across the company, we hardly ever have positive outlooks. Our sector outlook is usually either negative or stable for every sector. And they tend to be a little bit lagging, right? Like we can see when things are negative and we go negative. And we try not to wait until everything looks really good before we go stable. So we're trying to really be forward looking about things might still look difficult, and there may still be more downgrades, and there may still be challenges ahead, but we're thinking that a year or two down the road, we're going to look back and think that was the time when things started to stabilize. That was the bottom. And who knows if we're calling it right or not, but that's what we're hoping, is that we think that things really have kind of bottomed out and are going to start to improve next year. It's getting there. So I think it's probably just on that kind of cuspy difference of view. I don't know. Emily may have a different view, but.
Yeah, I do think we're still seeing that, at least in our view. I don't know that we're at the bottom yet. I do think we are slowing down the decline. I will say that. I do think the trajectory in this year is unarguably more favorable than it was as we headed into 2023. So I think it's a question of degree, perhaps, some of the dynamics that play around enrollment in particular, we're still concerned about, and certainly this FAFSA rollout hasn't helped at all alleviate any of those concerns. And some of the stabilization that we saw in enrollment last fall, in our view, we're still seeing signs of weakness. But again, I think those signs of weakness are not uniform across the sector, and they are certainly being borne by a disproportionate share of smaller, more challenged, less selective schools.
And just to reiterate the point that you all have made, is that the sector outlook doesn't necessarily predetermine the rating that an individual institution will get. And so I want to kind of move into that realm a little bit. And before we get into growth strategies and all of that, one of the key factors is always around stability of leadership management. This was kind of this past year was very interesting with all the issues around the presidents of universities and so forth. And so do your organizations have opinions relative to not only the number of high profile presidential resignations that happen, but also the spotlight that's been put on the communications from the presidents of the universities and how that plays out. Emily Wadhwani, why don't we start with you?
Yeah, and I will say that anytime there's sort of, this is a sector with high headline risk, right? I mean, these are institutions and people that are in the public eye, serving a public, good, oftentimes at the behest of a public legislature. That is sort of a pre-existing condition and is part and parcel with taking the role of being the president. In our view, sort of this type of the dynamic and sort of the unfortunate outcomes for two presidents, really. It's not that tenure in and of itself or lack of turnover in and of itself is a good thing. Rather, it's sort of the effectiveness and demonstrable, policy, transparency, and in practice that these cabinets beyond the president exude over time, and at making sure that their sort of their vision and their strategy filters beyond, the walls of the cabinet. And so the bigger risk in our view is whether or not that transition becomes a disruptive and a major disruption in the function and the strategy of the university, or if it becomes, for lack of a better word, another bump in the road, a highly visible and very painful bump in the road. And that, succession planning isn't an event, it's an ongoing, mindful, strategic process that should never sort of stop, in our view. And so whether or not that's the case, I think time will tell, but it's certainly been a challenging time for those two schools in the spotlight, certainly.
Okay, so let's shift from there to the various types of growth strategies that we're seeing around the country. Some are growth, some are defensive, but one that we're seeing is colleges and universities looking at their tuition structure. Some have actually rebased their structure and hopefully rebased their discounting along with it. But I'm just curious what your perspectives are relative to rebasing of tuition, relative to discounting, and what you're seeing. And maybe and Jess, we'll start with you. Maybe it's bifurcated there too. I don't know. But I'd like to get your perspectives on that.
No, I mean, I think it's a really interesting strategy. And, we've seen it's not new. If we go back over several years, we've seen a lot of schools, several within our rated universe, reconfigure their tuition. And for people that don't know how that works, say hypothetically your tuition is 40 grand a year, you've seen schools reduce it to 20. And then of course, at the same time, they're reducing their institutional aid. So, so net tuition revenue, ultimately, you'll see some of the differences there. But as we look back over time, I think it's a mixed bag in terms of how successful those reconfigurations have been. I mean, I think sometimes I can think of a couple examples where you saw it was successful at first, and then it's sort of, over a couple of years, you start seeing tuition go up again, and maybe at larger amounts. And then we've seen some that have successfully transitioned to that lower gross tuition dollar amount. So I think in terms of our opinion, if a school has a strategy, an initiative, and implements it, we're looking at sort of how successful that is and that implementation, and from there, really credit implications and what that means. So implications on enrollment, on demand, and then overall financial profile. So I don't think there's an easy, I think sometimes it works, sometimes it doesn't.
So
There's an
just, oh, go ahead, Emily.
There's an interesting kind of psychological element to it, right? Because you may get people who say, well, I'm going to apply because it's only 20,000. I wouldn't have applied if it was 40. On the other hand, you may prefer to go to a school that costs $40,000 but gives you a scholarship for 20 than go to a school that costs 20, right? You feel like you are special to go to this expensive elite college versus going to a cheap college, right? So I think that there's both of those kind of psychological dynamics at play, and agreeing with Jess that we've seen in sort of individual colleges that have done this, we've seen it can cause a bump in enrollment and applications for a year or two, and then that bump seems to kind of rebase itself and it kind of goes back to normal. So we've seen kind of the same mixed results. I think that maybe it works for a year or two, but it doesn't seem to have a really long-term benefit.
So are there any guardrails or as you look back on that strategy and look at how successful it was, metrics that colleges and universities can use to manage that process if they pursue that strategy?
I don't know. I mean, I think it's probably a matter of if they want to go that route and try that strategy of making sure that they are, targeting the people that they want to target and keeping the message really sort of aligned with what they are going for and the students they are trying to reach and the mission that they have as a school.
Yeah, I think it's really, for the schools that have successfully done this, transitioned that way, I think it's the messaging, alumni engagement, the marketing, the branding, really how they go about doing it. I think that really, is critical to whether it's successful or not.
Yeah, because once you do it, you can't go back. Yep. So another strategy not really along the same lines, but it plays into it, is the strategy of using the athletics as a means to grow enrollment. And there's been a lot written about it. If you're in that elite dozen or so, 20 or so colleges that get TV revenue and so forth, the numbers are huge. But what are you seeing in terms of the success or issues around that kind of a strategy? And let's, to use an S&P word, let's bifurcate it, right, from the two different kinds of schools, because it's an important distinction. And maybe Emily Wadhwani, we'll start with you this time.
Yeah, and thank you. So it's a good question. There has been a lot of movement in athletics in general in the last few years, and as schools sort of shift conferences and things. Obviously, there's been a lot of movement just within and around the NCAA and the pay to play, sort of trajectory and what that means. But just as a strategy for enrollment growth, where we've sort of seen most of it, at least in our portfolio and in the space, has been NAIA to Division III or Division III to Division II, and not necessarily certainly not in the Division I space where most of the dollars are and most of the most of the bandwidth is. We know that athletics in and of itself is not the revenue driver. It's a recruiting tool. It's a let's build a campus community exercise. And to the extent that it has been successful for some schools, we have seen at least some near-term success around enrollment at shifting and being able to offer scholarships at a higher level as a recruiting tool. But again, there's a long tail once you start to build these programs and recruit these students. It's important in our view that you have a long an understanding of what that means in terms of your margin and your expense base. I mean, athletics is typically a loss leader department. It's not a revenue bracket. So the challenge there is to balance, is your net new enrollment, is that enough to sort of sustain you over the long term? Because it's even harder to unwind athletic departments once they're built and running and functional and providing you with recruitment, even if they are now driving losses. And so it's a balancing act, and certainly one that we've seen some schools be successful at least in the short term. But again, I think the proof may be a few years longer down the road.
Jess, I think you wanted to say something.
Well, I wanted to add to it because I think it's really interesting, like Emily said, all the headlines about athletics, we're often talking about, the elite institutions that have the big football teams, the big basketball teams. And, that is where a lot of the attention is. And of those, it's a smaller number that are profitable, specifically, like Emily said, from their athletic department. But beyond that, profit aside from that department, there's alumni engagement, there's donor dollars, there's fundraising that are very heavily focused on athletics. It's just a big attention. It is just something that alumni are very passionate about. And then, so it has impacts on the overall university entity, whether it's profitable or not. I think it is important from that aspect. And then when you look down at sort of the other end, we rate a lot of schools, smaller regional schools that have actually had very good success over the past several years, making investments in athletic departments, in athletic programs, adding sports. Because the reality is there's demand for that. If you think about it, there's so many high school athletes that want to play in college, but maybe they aren't going to play at that D1 level, but they want to play and they also want to focus on their academics. And to be able to find institutions that offer you both, I think we have seen some schools have good success with increasing enrollment and recruitment because of specific athletic programs. But again, like Emily said, not every program is successful, and not every school is going to be able to do that. But we have seen some success there. So it's a really interesting area, the whole athletics revenues, arena.
Emily Rames, do you have anything you want to add?
I mean, just that I think to sort of add on to the extent to which it drives enrollment increases or philanthropic gifts, it's going to be hard to pull apart, right? So there's kind of the risk of, it's going to be a cost investment, and the benefits are going to be hard to sort of see and quantify and pull apart from others. So there's a little bit of that risk, but definitely, alumni like it. And so there's definitely, there could be the sort of increased giving and donors. And so definitely that benefits there, but a little bit hard to really quantify, although you can quantify the amount that you're spending on it. It's hard to see exactly what the benefit is.
So I'm curious, when you have an institution that comes and describes to you a strategy like that, or other growth strategies, as analysts, how much detail, how much analysis do you want them to present to you to prove out that strategy, and of course to establish metrics against which you'll be able to go, you said last year that you were going to do this, but how much of that, I'll call it business planning, are you looking for in order to really assess the potential value of that strategy? So Emily Rames, we'll start with you again and we'll work backwards.
Sure. The more the better is I guess my sort of short answer. If we hear our strategy for growth is X, that's sort of like the absolute minimum. We would love to see, not just the plans for growth and what it's going to take and how you're going to get there, but the funding sources for it, right? And the specific funding sources for it, and the kind of annual plans, what you expect to see by what year, as well as off ramps. If this doesn't happen, if this is more expensive, if this doesn't happen by this time, here are the things that we can do, right? Because plans don't always work out exactly the way you think. So what are the kind of contingencies? What are off ramps you have? And then, in terms of assessing the plans, we would sort of be looking at how aligned is this with your overall mission? what is the competitive environment that you are in, and how does this fit into that environment, right? Like, not every college should start a nursing school, even though there's a demand for nurses. If every school says we're starting a nursing school, right? Like, some are going to be better positioned to do that and have it be successful than others. So we're going to be looking at what is this plan for growth? How does it fit in with the mission, with the college, with the environment, with the competitiveness of your school in your state and for your students, and then sort of in terms of future projections, as the more the better, right? If you're telling us here's what we're going to spend over the next 2 years and here's what we're going to get over the next 2 years, we'd much rather see that you're planning out 5 years or beyond to see exactly how that's going to work, because it shows that you're planning long term, you're looking long term. So yeah, that would be kind of the starting point, I think.
Before one of the others of you answers, let me ask, when in a situation, what you've described as the ideal, when you don't get that, what level of discounting, if you were to use a bad word, but the discounting do you do to that strategy, and saying, that's nice they're talking about it, but have they really even thought it through? And should we apply that to our analysis for the credit?
Right. I think that there are sort of two pieces to the answer, and one is that generally we, not just sort of as higher ed analysts, but as analysts sort of much more broadly, wait and see, want to see the successes before expecting them, right? So much more generally, if you tell us here is our plan for the success we're going to get, we are going to wait and see, because things don't always play out, right? So we are often a little bit more of the we're going to wait and see. But the other piece is our assessment of the management and governance of the college and university, right? So if we have seen over the years with this team in place, or if we have seen in the meetings we've had that this is a team that has a lot of experience and past success with growth plans, expansion plans, keeping to budget, keeping expenses reined in. If we have that kind of assessment of the governance, we might give a little sort of more credence to this plan and think, okay, they've got this plan. We think this is credible because our assessment of the governance of this college shows that they've done this in the past. They came from this college where they implemented this exact type of thing, that kind of thing. So I think that while we tend to be more of the skeptical and show us the results before we really count them, we will put some, if there's the assessment of kind of the governance and management, we will put that into our thinking as well.
Emily Wadwani, what's your perspective on all that?
Yeah, I mean, I'll never say more isn't better. I think that's the answer. What happens when we don't, and I think what happens when we don't see, just to piggyback on that, and again, I think I echo a lot of what Emily Raines already said, but we will do our own sort of stress analysis. What if your revenues are delayed by a year? What if your expenses are 5%, 3%, something higher than, something reasonably higher than you initially expected, just based on macro conditions or supply chain issues? We did a lot of that exercise, an exercise in futility, one would argue, during early 2020, when we were all trying to sort of game out what the pandemic would bring in terms of not only lost revenue but increased costs. And so we've flexed that muscle before, and when we're working with an issuer, and of course we'll be transparent about that. If they don't have their own sort of break-even analysis, and most likely highest risk, lowest risk scenario that they've sort of worked out in their own methodology. What we're trying to avoid is a rating transition without that we should have seen coming, just based on the logic of the the conditions that are being presented to us. And so our goal is not to sort of rate where the puck is, of course, but rate where the puck could go. and to communicate that effectively. And so in order to do that, we do need to have from them, or we will craft our own plausible sort of outcomes, either best case, worst case, mid case. And the best and most comprehensive, responses that we've gotten from institutions means our work is done for us effectively, and we can use that as sort of a barometer in order to build our sort of forward rating case out.
Jess?
I think the Emilys have covered it pretty thoroughly. I don't know that I have a lot to add. I mean, I think what they've both said is that whatever information that we're presented from an institution, we're going to ask questions. And if it's not enough, or if it's too much and we really need to drill down and kind of get into the line items by line item, we will do that and we will ask for it. And we'll apply, like everyone said, sort of historical precedent, our views on management to those assumptions. Yeah.
The one word of warning I heard from Emily W. was, if you don't do it, we're going to do it, and we're going to use our own assumptions. So better to put your own business plan out in front and have done the sensitivity and all of that and present it, than leave it in Emily's hands, because who knows what she's going to come up with, right?
Well, you'll
That's
know
right.
what I come. We will share it, but it may
That's
not.
right.
It may be more conservative than you would have done, or it may not. Maybe missing some key insight that you have around, just the details. And so, better it come from you and have us ask questions than the reverse, I think.
And to that end, as you go through the rating process, have you seen the number of credits that come forward, including multi-year, Emily Raines, to your point, beyond 1 year, next year's budget, multi-year projections for the institution writ large with underlying strategies? Are you looking more for that than you were, say, 3 or 5 years ago? And are you also seeing not only incoming cash flow projections, but balance sheet related projections? Jess, maybe start with you on that.
Sure. I mean, and I'd be interested if Emily and Emily have different views. I will say we love to see that. And in several other sectors, healthcare, for example, as you know, the reporting is more frequent and the projections are, we don't always see that in higher ed. Schools are doing multi-year planning and we see that, but do we always see, multi-year projected income statement, balance sheet? No. It would be great to see more of that from institutions, and we're not always seeing that.
Emily Raines, are you having the same experience?
I can't really speak to are we seeing it much more than we did in the past. I'm relatively new to the higher ed sector. I came from the state rating sector, where states often tend to provide 5 to 10 year forecasts. But I'm thinking of a meeting that we had with a university recently where they presented a 10-year forecast, and the lead analyst was like, "This is the best. We almost never get this." So I think that generally, like the good out-year forecasts, we really appreciate it, and we don't always get them, for sure.
Emily Wadhwani, same, different?
Yeah, I will say I think we are seeing more. And certainly, I wouldn't say we're seeing on the long end. I think 5 years is generally the typical length of time we tend to see projections for. I'd be skeptical of much beyond 5 years from anyone, including my own budget. But that I will say, I do think we are seeing more of that from, and I think our impression is that if you don't have that as part of your planning sort of framework internally, it's one thing if you don't want to share it externally. That's hurdle number one. But if that's lacking as part of your own sort of fiscal and operating planning strategy, then we have questions, I think. If you aren't looking at multi-year sort of operating and planning and capital efforts, because many of these things have to be multi-year efforts. for many schools, then I think we have questions, and then it just becomes an issue of, I think, transparency and communication, and packaging it in a way that is fit for sort of public consumption, and that's sort of hurdle number 2. But I will say we're seeing more of it. I don't know that we've reached the point of expecting it across the sector like you would expect in other sectors, but it is something that we ask for, and for most schools, we're getting some form or fashion of that, along a spectrum of sort of sophistication, if you will, and polish, but yeah.
Yeah, so Jess mentioned healthcare, and for a long time in healthcare, there was no expectation, but there were events that occurred in the sector, general major bankruptcy and some other thing, and suddenly you never actually say you have to do this, but it was an implicit you have to do this. What is it going to? What do you think will it take to move higher ed from where it is in terms of all of this to being much more of that implicit mandate for business planning and having these kind of this multi-year look that then becomes the metric you're using to, in addition to management and all that, that's a metric to evaluate success, ongoing success, failure, or validity of the numbers that you're being presented. Maybe Jess, since you brought up healthcare, I'll start with you.
Well, I think that's a really interesting question, and we see what's going on in the higher ed sector, where, and you can compare to healthcare, where like you said, in bankruptcy, but also you see a lot of M&A, and sort of that evolution maybe around the financial reporting and the budgeting and what's being prepared. And I think, like Emily said, there has definitely been improvements around financial policies in higher ed over the past several years. And I think in terms of the budgeting and what's being put together, it is becoming more robust. And I think part of that is because we do have a sector that is facing some pressures, and especially at the lower end, we do have some struggling institutions. And I think that schools that are struggling are realizing that they really sort of need to be planning ahead and looking at, especially with uncertainty around enrollment, sort of planning ahead financially and looking out, those next 3 to 5 years and making strategic plans. So I think maybe there's a bit of maybe we've reached sort of a tipping point. Maybe we will see more of that because of what's going on in higher ed that doesn't parallel healthcare, but there are some similarities in some of the trends we're seeing.
Emily Rames?
No, nothing to add on top of that. I think, okay. Yeah, we may see more coming, and that would be great, especially given the challenges in the sector. But yeah, nothing else to add.
Okay, so Jess, you mentioned M&A. So Emily Wadwani, I'm going to throw it to you. The level of merger, consolidation, formal affiliation of colleges and universities, there's been some. Mm-hmm. It's not a tidal wave by any stretch of the imagination, but do you see that trend? Are we getting to the crest of the wave, or is it just going to keep the little trickle that we've seen?
Yeah, it's almost like just a constant drip, and sometimes it drips a little faster. And I do think so. We do know that the pandemic and the related stimulus did mask a lot of pre-existing operating and other pressures in the sector. And now that that's gone, mm-hmm. Our expectation is there will be a mild increase in consolidation, and it'll look different for public institutions than it will for private institutions. The ones we tend to see are the big, we're 6 months from now, we're closing our doors. That's sort of the worst end of the spectrum. And at the other end of the spectrum, it's, we're going to shrink our programmatic base. We may discontinue, underwater basket weaving. We're going to close that department. We're going to, make some tweaks and right size what we need to right size so that we have a sustainable platform. And so there are many things that look like consolidation. And what I think you're asking though is will we start to see a big pickup in sort of the traditional M&A and
corporate consolidation, we'll call it. Yeah.
Yeah, and this isn't a sector that does M&A well, and there are reasons for that. It's not unlike healthcare. There's a whole, my colleague calls it sort of an octopus arms of constituents that all come into play when an institution's in distress. You've got donors, you've got students, you've got families, you've got legislators, you've got the political legislative body in terms of oversight. Of course, the Department of Ed is a major player and becoming even more so. The faculty, often the loudest voice in the room. And so hospitals don't quite have the same type, not only the sheer number of stakeholders, but also with the same level of, I think, voice in the discussion. And there are also, the difference here too is identity and brand, I think, are very foundational here in a way that it's not quite the same as it is in healthcare. And so I think those two things are very big hurdles to overcome when we're talking about merging institutions. It can be done, we've seen it done, but we've as often seen it fall apart, I think, on a multiple times basis than we've seen it be successful. And those identities, there is a very real, I think, need to self-preserve in this space that doesn't necessarily exist in the same way in other sectors. I don't know that donors feel strongly about, I don't know, name a brand of healthcare institution as they do about their alma mater. It's a different relationship that patients have with their hospital than students and families and faculty and alumni do with their university. And so I think those things are big hurdles that are often not overcome, quite frankly. And that's not even getting, touching sort of the institutional, cultural, procedural systems integration that has to happen for those things to be successful too.
I think
all that said, we do think consolidation is going to accelerate. We think there will be more closures, at least for the next few years, before they sort of stabilize, at least in our view. And most of those will be smaller, more tuition dependent, unrated schools that are unable to find a partner, or quite frankly, just have decided that finding a partner is untenable. The Department of Ed recently released a couple new rules that it's going to make it even harder to make these things happen, lengthening the time for schools even contemplating a merger and acquisition. Time may run out by the time the Department of Ed sort of gives a thumbs up or a thumbs down for some of those schools. So that's a challenge.
The other Emily, you wanted to say something?
Yeah, I was gonna sort of comment that on that timing aspect, that I think that all of those hurdles that you mentioned mean that often you get to a point where, while consolidating or merging might have been a good idea at some point, by the time you go through all of those hurdles, that time has run out, right? And the institution has no liquidity left and has decayed facilities that they haven't put any money into, and it doesn't look like a good candidate for consolidating with anymore, merging with anymore. So, where that might be a good option at some point, all of those hurdles that you mentioned, having the donors and the alumni say, no, you can't change your name, all of that time that's spent, it kind of runs down the clock and makes it so that it's no longer a good idea or proposition. It's no longer an attractive merging candidate.
Yeah, I find those. I mean, those comments are to me spot on, but it ties back to the earlier part of the conversation, which is, if you're doing projections and you're doing that business planning, then you're going to get that longer term perspective and maybe get out ahead of that curve. So before everything goes to hell in a handbasket, you have an opportunity to really do some strategic things. And maybe Emily, one of your point about it being much more difficult to merge, I'll call it corporately, but there's opportunities within that in terms of programmatic mergers, back office consolidations, and so forth. And we see that in various sectors as well. So how do you from your platform get that message across to folks? Because you can't do their work for them, right? But how do you use your platform to bring that message, other than in situations like this, I guess?
Yeah, I think it's all about. I think it does come down to the ongoing dialogue that we have with each of our issuers, and I know that that's a bit of a cop out, but the same things we are always asking for, the same questions we are asking. What we often hear back is that, oh, this has been a really good exercise in sort of making sure that we're doing the things where we should be doing, getting your perspective on where we should spend some of our time and energy around our strategy is actually helpful, and I can bring that back to my board, and so I think some of that happens on an issuer by issuer basis. It's our role is tricky. We sort of call it. We don't decide the play. We just call it as we see it.
Right.
But I do think a lot of that work happens on a one-on-one basis as we have these ongoing discussions around forward expectations related to strategy, related to spending, related to liquidity, related to help us understand the demands on your cash and how you manage them, sort of questions, in a way that hopefully prods continued work toward more sophisticated, I think, planning efforts in some cases. And we do have some. We do have some good. There are many that are best practicers, and I think they know they are. They know who they are.
Jess, you were going to say something.
I was going to add, I mean, similar to Emily's points, obviously as rating agencies, we can't structure, we can't advise institutions, but I think something that I have found to be very unique about the higher education industry is the level of kind of communication and respect amongst institutions and peer groups. I mean, almost every school we talk to says, oh, like we're part of this peer group and we're monthly meeting with either other treasurers from similarly rated or similar, types of schools, and whether it's treasurer or provost or admissions management. And I think also what we've seen over the last, several years is this is a sector where schools share success stories and also share when something maybe doesn't go right, because when you go around to some of the conferences, the Wakubo or Nakubo or Sakubo, and schools, representatives from institutions are willing to, go on panels and share implementation stories and talk about strategies that worked and maybe things that they learned, and share that information with other institutions. So I think that is one thing that's pretty unique, and I think schools do learn from that and can talk about different potential strategies they're looking to put into place.
Emily Rames, were you wanting to add to that, or?
No.
No. Okay. So in the last few minutes that we have, I guess I'm wondering, we've talked about a bunch of different things, but are there areas as you interact with issuers, are there areas that those issuers are not focusing on that you would really want them to focus on beyond what we've talked about? Who would like to go first? Emily Rames, we'll start with you.
And beyond projections, we've talked about that. Would love more of the projections, more detail, I guess. And I kind of mentioned before, detail on not just plans, but on funding sources for that and exactly where that's expected to come from. Line iteming things as much as possible. To the extent that you're planning getting to budget balance and telling us we're going to get to budget balance, detail on spending cuts. We often don't get that, and we find that very helpful, right? Hearing we're cutting spending by 4% this year is not nearly as helpful as here are the number of positions that we are eliminating. Here are the number of empty positions that we are not filling. Here are the program that we are cutting. Like that kind of detail, I think, is extremely helpful, and we really appreciate that over just we're going to cut spending by 4%, because I think that always comes with like, well, maybe you are and maybe you aren't. How do we, it's hard for us to assess whether that is likely to be successful or not. So detail, particularly on kind of expense measures, I think is something that we don't always get and we find very helpful. So more of that.
Okay. Jess, from your perspective?
Yeah, I think that when it comes to each unique, particular institution, I think focusing on sort of those areas that are of strategic importance. So if you happen to be an institution that has maybe faced enrollment declines for several years, I would spend more of your time focused on the enrollment strategies, recruitment, and sort of where the students are coming from and what the admissions department is doing and how that works with financial aid, and sort of focus more on that story. If it's an institution where maybe operations have been more volatile over the past few years, or maybe fundraising has been weaker, or there's a significant amount of debt, maybe spending more time focusing on those particular areas and providing, like Emily said, more detail, more telling the story, really more of the story. Why are you making these decisions, and why, and what that are reflected in those numbers? Because that's what really helps us when we go to committee to talk about all the different credit factors. We're telling the story, and so what's shared with us is very helpful to give the why behind. Okay, well, maybe this school's had deficits for a couple of years, but maybe they were planned for this strategic reason. Let's talk about it. So I think, just like Emily, kind of piggybacking on that, but more detail on the areas that you think are maybe of strategic importance.
Emily Wadhwani, anything to add?
The only thing I would add is it's useful for us to have answers to all of our questions. It is equally useful when you don't know to hear how you've planned for an unforeseen something. We don't expect you to have everything tied up into a nice little bow for us every time, especially when you're embarking on something that is challenging or of magnitude or of long duration, what have you. A good example is some of these, we're gonna shift into health sciences and build a nursing program. Okay, well, talk to you in 8 years when you're when you've gotten your first class graduated and test scores taken. So we don't expect you to know what that's gonna look like, but it's useful to understand how you've planned for the unknown, for contingencies, for I think, as Emily Rames put it, what are your off ramps? At what points do you have an off ramp if you need to vacate this strategy, or this line of expenditure, what have you. So we rely on transparency, and of course there is concern that what we hear is going to end up in a rating report. We all are required to not put confidential things in our rating reports, and we're very sensitive to that. But our analysis is only best informed by that transparency, by their willingness to sort of share not only the great, here's what we know is going to happen, it's going to be great, but also we're not really sure if this could happen and it could be bad. We also need to hear that, and I think there is a lot of sometimes push-pull around that dynamic. We don't just want to hear the good story. It doesn't help us.
I think the important point is that I'm sorry. I was going to say, you are the tale teller, if you will, for the issuer at the rating committee. And so the more you know, and while you may share confidential information verbally, it won't show up in the rating report. But the more you know, the better you can talk about that credit and actually get a better outcome around in total.
Yeah.
Are there oddball issues that are being asked at the rating committees that we haven't talked about that people should know about? Jess, any?
Coming off mute. Oddball issues. I mean, I think honestly, anyone having a call in the next few months, fall enrollment's a hot topic. And as Emily mentioned with the FAFSA delays, it could have a significant impact on acceptances, on application, well, really on acceptance deadlines. We're already hearing some schools pushing back deadlines. I mean, this impacts not only could impact overall enrollment, but it impacts financial aid. It also impacts institutional discount rate and what schools are planning to give. And that, again, that'll impact fiscal 24 budgets. So sorry, fiscal 25 budgets. I mean, there's, you know, so there's, I think that's not oddball, but that's probably going to be key question over the next. Yeah.
Okay, really quickly, because we're basically out of time. Emily Rains, any issues you're seeing at the rating committee?
Yeah, I mean, I guess one thing that we sometimes see at committees is when the analyst is presenting, you know, here are the issuer's plans, had the discussions, here are the plans. The committee members will often ask, okay, well, what is the sort of expected liquidity? What do we think about expected liquidity out in the forecast, right? Because there can be good plans for enrollment growth, but with the amount of liquidity they have, if things continue as they have, you know, last year and the year before, how long is that going to last? And, you know, understanding that sometimes we're talking about kind of worst case scenarios, if the plan's not panning out, but, you know, that especially kind of at the lower end of the rating scale, liquidity sort of projections and forecasts are something that if we're not getting, we are doing and talking about a lot in the committee.
Okay, Emily, anything you're hearing?
Yeah, nothing. I would say nothing oddball. We are forever skeptical of revenue growth strategies. That's something we're going to have a million questions about. And to Jessica's earlier point, a lot of the low-hanging fruit around expense controls we think have been the juice for the squeeze is diminishing at this point. And so we will have a just sort of foundational level of skepticism around or need for confirmation around those assumptions. And so again, certainly not an oddball, and probably just a long, old, boring standard.
Fair enough. Well, thank you so much. Jim, I'm going to pass it back to you for a wrap up, and thanks everybody for participating.
Thank you, Jason, and thanks again to our panelists. As a reminder, you'll be receiving a link to a recording of this webinar within the next day or two. And thank you for joining us, and have a great rest of your day.